Hello, my name's Colin Moore. I'm the Global Chief Investment Officer for Columbia Threadneedle Investments, and I'm joined here by my colleague Mark Burgess, who's the Chief Investment Officer for Columbia Threadneedle in Europe. We clearly want to talk to you today about the turmoil that's been affecting the markets. What are the causes of that, and probably more importantly, what are the implications going forward? Mark, I think one of the key questions we keep getting asked is this 2008 all over again? What's your reaction to that?
Well, I don't think it is. Clearly the market's readjusting to lower growth expectations, but if you remember, 2008 was about severe financial stress brought about by over-leverage and an overinflated housing market. Neither of those situations persist today. We've seen a significant deleveraging in the financial system, lots more capital, particularly in the US banking sector, and the housing market's not overvalued, so I don't think it's 2008 at all.
Right. I mean, some of this has really been, we got a little excited about the level of growth, and we're now having to adjust, which has a material impact on the valuation of the market. But it's different if you're coming down to form a new solid base based on those newer, lower expectations versus we're collapsing, as you say. We don't have that financial instability. But nonetheless, people are concerned about a couple of big topics: China, oil. Give me your views on those, and indeed, are they in some way linked together?
Absolutely, they're linked. The Chinese economy is rebalancing away from an investment-led model that we saw for the last 4 or 5 years, and that had the consequence of driving up commodity prices as China invested heavily in its economy, in infrastructure, and those higher commodity prices led to significantly increased production, particularly in North America. So we're kind of getting our heads around two things. So first of all, the Chinese economy is slowing down, and secondly, the fall in commodity prices is impacting growth in a particular segment of the US economy with industrial production and oil production. And I think we're trying to understand the impact of that on growth more broadly and profitability in those sectors.
We're not minimizing the amount of risk. There is risk, but the question is, do they spread to this sort of level of global contagion we have last time? And I don't think you think they will do that either.
No, I mean, Europe continues to grow, and we've got quantitative easing supporting financial markets in Europe. Clearly, we've got quantitative easing in Japan, and markets are being supported there. It's just about a reassessment of the growth rate, recognizing that equity markets had done pretty well over the last 7 or 8 years on the back of zero interest rate policy and quantitative easing. That's unwinding a bit, and so growth rates are coming down, and markets are adjusting to that. But I don't think it's 2008 again by any stretch.
And a lot of people are saying, what's the Fed caused this by putting interest rates up. The quarter-point change in interest rates didn't cause this. And interestingly enough, most interest rate increases are actually done out of concern. The Fed is worried about inflation or excess growth, and they're trying to dampen that down, or they're worried about fighting deflation. In this case, it's more relief that the U.S. economy is normalizing, and they're looking to restore monetary policy to a more normal condition, which I think ultimately will be taken positively by the marketplace. But transitioning off the drug of financial stimulus is not easy. Anyway, we think that the setback, while it's painful, is much more to do with this resetting of growth expectations. And that doesn't have this level of contagion into the really ugly situation that we saw in 2008, which was exacerbated by the fragility of the financial system. Yes, there may be problems with lending in China, as we discussed, but that is unlikely to be contagious across the global platform. People have even compared it to 2011 with the sovereign debt crisis in Europe, but we're just not seeing that scale of crisis today. So while things are perhaps unpleasant, I think it leads to this resetting of expectations, which in many ways should be seen as a good correction because it helps restore a better balance to the marketplace.